You're opening the mail after work, half thinking about dinner, when your mutual fund company says your fund is becoming an ETF. The question is not whether ETF sounds modern. The question is whether this new wrapper makes your portfolio better, cheaper, and calmer, or just easier to trade. We'll follow Maya, 39, a product manager with a taxable brokerage account, an old rollover IRA, and exactly 20 minutes before her next meeting. VettaFi reported mutual fund to ETF conversions crossed 200 over 5 years and converted assets past $260 billion. That is no longer a side experiment. Think of a fund wrapper like the container around leftovers. Same meal, different container. It changes storage, access, and spills. It does not improve the recipe. The pace jumped in 2025. VettaFi reported 60 mutual funds converted into ETFs that year, the highest annual count in its data. For Maya, the first question is location. A tax-efficient wrapper matters differently in taxable brokerage than inside a retirement account. Inside an IRA or 401k, annual capital gain distributions usually do not hit your current tax bill. The ETF tax advantage may matter less there. Plain English, this is not financial advice. This content is for educational and informational purposes only and does not constitute financial advice. Always consult with a qualified financial advisor before making investment decisions. Maya's mutual fund priced once after the market closed. She placed an order, then waited. No drama. No staring at a flashing quote. The ETF version trades all day. That sounds empowering until you remember empowerment can become temptation when markets wobble at lunch. A wrapper that lets you act faster is useful only if faster action improves the decision. Pause. For long-term money, speed is often overrated. ICI reported April 2026 long-term active mutual funds and ETFs held $18.19 trillion, while indexed long-term funds held $20.80 trillion across the industry. Those numbers explain the sales pitch landing in Maya's mailbox. Asset managers are not just serving demand, they are repositioning products toward where money is flowing. ICI also reported long-term active funds saw $21.25 billion in April 2026 net outflows, while long-term index funds drew $124.14 billion in inflows. That flow gap is the soundtrack behind the migration. When investors vote with dollars, fund companies redesign shelves, packaging, and sometimes the whole store. SEC Commissioner Mark Ueda said ETF share class relief could allow one fund to offer exchange-traded and traditional mutual fund shares, subject to safeguards. That matters because a future fund may not need a full conversion. It could give investors parallel doors into one underlying portfolio. After Vanguard's early ETF share class relief and patent era, the 2023 expiration opened the door for rivals to seek similar structures. Now the tax part. In a taxable account, ETFs often use in-kind redemptions, moving securities out without forcing the portfolio to sell. For Maya, that may mean fewer surprise capital gain distributions. Fewer surprises are not the same as lower total taxes forever. If your mutual fund sits in taxable brokerage, consider comparing its past distributions with the ETF's expected process before you automatically approve the switch. Read the conversion notice slowly. You are looking for tax treatment, ticker, expense ratio, portfolio changes, and whether your cost basis transfers cleanly. VettaFi counted 203 conversions over 5 years, but only 174 surviving ETFs after 29 liquidations. Migration does not make every product permanent. A liquidation is not usually catastrophic. Soft exhale. But it can force cash into your account, create tax timing issues, and interrupt a plan you liked. Maya highlights 4 lines: expense ratio, strategy language, tax section, and trading mechanics. Boring lines are where expensive surprises like to hide. VettaFi said converted assets crossed $260 billion, which tells you big firms are moving real client money, not only test products. Fees come next. Many ETFs carry lower expense ratios than similar mutual funds, but the spread between cheap and expensive still matters. Compare old and new expense ratios in basis points. On $100,000, a 0.20 percentage point cut may save about $200 annually. But a cheaper wrapper can still hold a high turnover strategy, concentrated positions, or a manager whose process no longer fits your goal. ICI reported active long-term mutual funds and ETFs held $18.19 trillion in April 2026, so active management remains enormous. So do not hear active ETF and assume sleek, simple, or low volatility. Active describes the manager's choices, not your outcome. Ask whether the mandate changed. If the same manager, holdings, benchmark, and turnover stay intact, the wrapper may be the main difference. Now we get to the feature investors notice first, intraday trading. Maya can buy at 10,017, sell at noon, and regret both by dinner. For less liquid ETFs, consider limit orders rather than market orders, especially near the open or close, when pricing can be jumpier. The bid-ask spread is the toll booth. The bid is what buyers offer. The ask is what sellers demand. The gap is your friction. A 1-cent spread on a large liquid ETF may be tiny. A wider spread on a niche fund can quietly offset fee savings. Also check premium and discount history. ETFs can trade above or below the value of their underlying holdings, especially in stressed markets. One approach, trade during the market's calmer middle hours, avoid rushed orders, and review execution quality if your brokerage provides it. Maya sees the new ETF expense ratio is lower. Good. Then she checks the spread and realizes every purchase has a tiny entrance cost. That does not mean avoid it. It means calculate the whole cost-expense ratio, taxes, spread, premium or discount, and your own behavior. The hidden question is turnover. If the strategy keeps buying and selling frequently, an ETF wrapper may reduce distributions but not eliminate portfolio churn. In retirement accounts, consider prioritizing strategy, fees, and allocation fit. The tax edge of the ETF wrapper may be secondary. Yuta argued the artificial divide between mutual fund and ETF share classes limited investor choice, operational efficiency, and tax outcomes for years. That is the regulator's modernization case. But modernization for the industry is not automatically improvement for the person funding their kids' college. Your job is to separate optionality from usefulness. More ways to access a fund may help only when they solve your specific problem. Some mutual fund features are genuinely convenient: automatic dollar investments, dividend reinvestment, and end-of-day pricing that discourages tinkering for busy professionals. If your paycheck investing runs on autopilot, verify the ETF version supports fractional shares, recurring buys, and reinvestment the way you expect. A fund conversion can also change how statements look, how orders settle, and how tax forms arrive. None is glamorous. All matter. Check your brokerage before conversion day. Some platforms handle fractional ETF shares smoothly. Others may leave small cash balances you need to reinvest. Rebalancing changes too. Mutual funds are easy to trade in dollars. ETFs may require share quantities unless your platform supports fractional trading. Set rules before emotions arrive. For example, rebalance quarterly, or when allocation drifts beyond the threshold you choose with a professional. The biggest behavioral risk is not the wrapper. It is the blinking price that makes a long-term investment feel like a live sports score. If the ETF makes you trade more, the lower expense ratio may not help. Lower voice activity can be a cost wearing a confident suit. Vetify called 2025 a record year for conversions, with 60 mutual funds becoming ETFs as firms followed demand and product economics. The industry may describe that as efficiency, fair, but investors should ask whether the new wrapper changes incentives for marketing, assets, and trading volume. Here is Maya's checklist. 3 questions, then a decision. Not because checklists are exciting, but because they slow down expensive impulses. First, where is the fund held? Taxable account, retirement account, college plan, or trust. The wrapper's value changes with the account. Second, did the strategy change? Same holdings, same benchmark, same manager, same risk profile. If not, the conversion may be mostly operational. The rally you're seeing in the Dow? There's more to that story: volume, premium, or discount, and whether limit orders fit your normal habits. Fourth, does it fit your workflow? Automatic investing, fractional shares, advisor access, tax reporting, and rebalancing can matter more than the headline. Maya calls her advisor not to ask, should I like ETFs? She asks, what problem does this wrapper solve in my portfolio? If this kind of practical portfolio breakdown helps, follow Money Moves daily. We keep it calm, specific, and useful for your next decision. By April 2026, ICI reported indexed long-term mutual funds and ETFs held $20.82 trillion, larger than active long-term assets. That is the tide pushing wrappers, fees, and product design, but tides do not tell you which boat belongs in your harbor. Do not follow a migration just because the industry is moving. Consider whether lower taxes, lower fees, or better access actually apply to you. When the notice arrives, save it. Read the tax section twice, then compare the old fund's purpose with the new ETF's daily reality. If the conversion may create a taxable event, consult a tax professional before trading around it. Timing can matter more than the headline. If nothing changes except wrapper and costs fall, staying put may be reasonable. But reasonable depends on your timeline, account type, and behavior. If the strategy changes, treat it like a new investment. Review holdings, fees, risks, and alternatives before letting inertia make the choice. Today's framework is simple: wrapper, strategy, account, cost, behavior. Miss one, and you may mistake a product redesign for portfolio improvement. The ETF migration can reduce friction and improve tax efficiency for some investors. It can also invite overtrading. The wrapper is powerful, not magical. Money moves best when the structure serves the plan. Until tomorrow, keep the signal, skip the noise, and make the wrapper earn its place.